Hi, I'm Susan O'Toole. I'm an attorney at Beresford Booth, a full service law firm here in Edmonds, Washington. And I'm here today with my friend Mihaella Bayla to talk about divorce mortgage planning, better outcomes for divorcing homeowners. I'm a family law attorney, and this is a subject that's coming up a lot lately, especially with the changes in the housing market. And I thought this would be a good topic for anyone thinking about a dissolution who owns a home with their spouse. So let me give you a brief introduction of Mihaella, and then we're going to just do a Q&A where she talks to us a bit about this topic and about how it can impact your dissolution. So Mihaella Bayla has been an attorney practicing in California and Washington since 2007 in the areas of tax law, elder law, and estate planning. In 2019, Mihaella transitioned to the mortgage industry, then became a certified divorce lending professional and co-started True Lending Company, a mortgage brokerage company in Edmonds, Washington. Mihaella's work is now exclusively focused on divorce mortgage planning by helping divorcing homeowners and their divorce team with planning and solutions for their home ownership goals post-divorce. Since moving back to the Seattle area, Mihaella has served on several boards, including the Washington First Responders Wills Clinic, the Mother Attorney Mentoring Association of Seattle, and King County Bar Association's Collaborative Law section. Mihaella also contributes articles regarding divorce mortgage planning to the Snohomish County Bar Association's newsletter. Please join me in welcoming Mihaella.
Thank you so much, Susan, for having me. This is a real joy for me to be able to talk about what I do, because it is a topic that most people have not heard about. And in order for me to reach more folks that I can help, this is really helpful to be able to talk to attorneys like you and really spread the message of what a CDLP does, a certified divorce lending professional, and how we can help divorcing clients.
Excellent. Okay, so why don't we get right into it? As you said, people don't know what a CDLP does. So why don't you explain your background and briefly what a CDLP does?
Perfect. Yes, thank you so much. So a CDLP is a certified divorce lending professional, which is a certification that is managed by the Divorce Lending Association. They have been around for about 10 years. They're relatively new, but they've made a huge impact within the divorce world, I should say. And the certification involves pretty rigorous training and examination, and then ongoing testing and ongoing mandatory education, training, and development. So the way that I describe it, it's really the intersection of family law, tax law, financial planning, and then the very specific mortgage programs that are only applied to divorcing homeowners for a very short amount of time. So some of these programs can only be taken advantage of if they are approached, planned, and done in the beginning process. Sometimes once that divorce degree is finalized, a lot of these options are really off the table. And so what I do is I help people who are going through a divorce. I really help them map out a course of action of how they can achieve their home ownership goals, and then help them through that process, making sure that their income looks the way it needs to look, that the assets are divided in such a way that it really helps them. It might be a very minuscule change, but it can make a huge impact on their ability to qualify for a mortgage. And we throughout this process, we sort of anticipate and kind of see what roadblocks might come up and come up with solutions for those roadblocks, so that at the end of their divorce, they're ready to continue with their home ownership or become new homeowners at that time without having to wait or find out that after all, they're not able to keep the house. My unique position, because I am an attorney, even though I no longer practice as of a couple of years ago, I've decided to maintain my law license. And this is because of the ethical duty that is basically required of me to have with my clients. I always put their needs first so that my clients know when they work with me, they can count on the advice that I give them. I also have a duty of confidentiality and zealousy for my clients. And so that makes me feel really good when I talk to someone. I let them know I will take care of your needs first. I'll make sure the advice I give you is very beneficial to you. And that immediately puts my clients at ease.
Wonderful. Can we take the screenshot or the screen sharing off here so that we can see your face when you're talking to us, and then maybe go to a like a speaker mode. So there we go. There we go. Okay, so in layman's terms, short answer, long answer, kind of what your process is. What do you do in layman's terms?
Yes, exactly. Short answer is that I'm a specialist when it comes to divorce mortgage planning. So I help clients who are going through a divorce to identify their housing goals. And then I create a roadmap of all the steps that they need to take together. And also, like I've mentioned before, is I sort of see ahead into the future of possible roadblocks they might encounter and also find possible solutions to those roadblocks. That's the short answer.
Okay, what's the long answer? What is your process? How do you do all these things?
Exactly. So my process is that I have free consultations with clients. I don't charge for any of the services that I provide. And my consultations are pretty detailed. I start off with what is my client's goal? Not just for home ownership, but also their budget, because those two don't always go hand in hand. I can have a client tell me, I would like a $700,000 home. However, my budget is $1,500 a month, and I only have 100,000 for a down payment. And I know those are not congruent. So bringing an expectation of what in reality is actually possible is a huge component. So marrying their goals with their budget as part of that. Then I go into information gathering. So I find out where they are in the divorce process. What are the property details? What does the income look like? What do the assets look like? The debts. So marital debts and the way they're divided can make a huge impact on a person being able to qualify for a mortgage. Student loans is one that comes to mind very often. Has got its own particular issues. So we talk through all these different parts of what makes up their financial profile. And then I create a very detailed report along with the narrative. And I have a second meeting with the client where I present my report to them, and I go through all the information provided to make sure that it's correct and clear. I explain the options, and then I start to narrow down the options to the client, because initially we may not know what it is that we want, but then once they start seeing the numbers, it makes a little more sense, and we can start narrowing in on a specific option they might want, whether that's a purchase or if they're trying to decide if they want to keep the marital home or move out and buy something else, whatever their specific instance is. And then once we narrow down that plan, then we start to really get crystal clear about the steps that need to happen and how we get them to that finish line. And a lot of my clients that I work with, this is a process that takes sometimes 6 months, sometimes 12 months, depending on where they are in the divorce process. Throughout this time, my aim is really to be a resource for them. I do my best to spend time educating them on the process, taking some of this away from the attorney's plate, because you're not expected to be a mortgage professional, and you shouldn't have to be. And so if I can do some of this work for you, some of this heavy lifting, where I actually educate the clients of what the options are, what it looks like, what steps they need to take, then I feel like I can contribute and be a resource for them, and it's really valuable. Yeah.
Was that it? I'm sorry, I didn't mean to interrupt.
That is it. So that is the planning process. I work with their divorce team by showing these examples, and then if the divorce team wants me to change any of the scenarios or new information comes up, then I make those changes along the way as needed. Yeah.
Got it. Okay, so tell us, why is divorce mortgage planning necessary? I imagine there's several parts to that. So why don't you tell us why it's necessary?
Absolutely. It is a really overlooked type of planning that can make the difference between someone being able to, for example, keep the marital home or not keep the marital homes. And I'll give you an example. I had a client, one of my first clients, when I started to do this work. Her name was Alice, and she was a single mom. And she worked really hard to be awarded the marital home. And she thought she had a lot of money coming through because she was working multiple jobs. And she thought for sure she could be able to qualify to basically refinance the loan to her name. That was one of the stipulations. Within 6 months, she had to do that and remove her spouse from the mortgage, or else she will have to sell. And she talked to a regular mortgage professional and said, "This is my income. Oh, yes, you'll be fine." Well, when it came down to it, it turned out that we couldn't use the income she had because it was part-time. And even though she worked really hard and gave up other assets in order to keep the marital home, when it came time to do the refinance, she did not qualify. And she ended up having to sell and to move her kids. And it was really heartbreaking. If Alice had access to planning, we could have put in all the different requirements that she would have needed to make sure she keeps the house. For example, extend that refinance deadline more than 6 months. In her case, she needed a little bit more to establish her income and her credit history and all the different pieces that were necessary for her specific case. And so for most folks, the planning can really make the difference because a lot of different things have to happen and fall in line, especially after a divorce, to make sure they qualify for a mortgage. And cases of support income, you need to have a certain amount of months of receipt of that support income before the support income becomes qualifying or is accepted for mortgage purposes. And so if we have that deadline too tight, too short, such as 6 months, it may not be enough. And so just even small changes like extending it to 8 months can make a big difference. In addition to that, there are some programs that are only available while you're going through a divorce. There's certain language that may need to be included in the divorce documents before they're finalized, the absence of which may again disqualify that client from being able to get a mortgage. Even to give you an example, child support. I've had a case where everything looked fine, but in the settlement agreement, it said that the child support was going to be reviewed in 2 years. Well, an underwriter saw that, and the lending guidelines require that income continues for a minimum of 3 years. That became a huge red flag. All we needed to do was, before the divorce was final, is go back and ask if both parties agreed to the language saying something like, the child support income is going to be reviewed according to state law, which, Susan, you know that means the same thing, but it doesn't trigger a red flag for an underwriter. However, in this case, the divorce was final. It was really, it was not a good situation. There was no way for them to go back and make that change. Therefore, we couldn't use the child support income, and this person was not able to qualify for a mortgage. In other cases, we may have to create income. If, for example, there's a big lump sum that comes through from the divorce, perhaps one spouse was a stay-at-home parent and didn't work, and they're getting a huge settlement, but they don't want to use all those funds to buy a house with, and they actually need those funds to survive. How do we do that? How do we still use those funds for everyday living expenses and only use the minimum amount for a mortgage when there has been no income and there is not going to be any income? And the answer is advanced planning. A trust has to be set up ahead of time. It has to be referenced in the divorce decree. Timing is really of the essence in cases like that. And so without the advanced planning, without the right timing, so many options are off the table.
Okay. So I know a lot of things have been changing lately. I mentioned the housing market, excuse me, at the beginning of our of our webinar, and I think that that's probably affecting a lot of things right now. So what are the top concerns in divorces right now?
Yeah, let me get back to you. That's a really good point. So right now, because we're in a higher rate environment, I should say increasing rate environment, uh, it's becoming more difficult for spouses to refinance and take their departing spouse off of a mortgage. And so assumable loans are one of the questions that I get almost on a daily basis. Can I assume the loan? In some cases, yes. We do call it the unicorn of lending, but there's some criteria around that, and I can go into it in a second. The other really important topics to understand that come up on a regular basis is support income, because that happens on a lot of the cases that we see, and it really affects lending directly, and also an equity buyout. So I'd like to actually take some time and go through those topics one by one, if that's okay with you.
Oh, that sounds great. Thank you.
Okay, great. I'm going to share my screen because I have a couple of slides ready, and let's see how we do that. Can you see my screen?
I can, yes.
Okay, all right. So first, I'd like to talk about support income. That could be child support, alimony, maintenance, all of the support income that could be awarded from a divorce. What's important to know about support income is that it has to meet stability and consistency tests. Usually what that means is that it has to be paid as ordered on time every month. So for example, if there is child support that's ordered for $1,000 a month, it has to be paid within that month, and it has to be paid in the full amount of $1,000, transfer from an account that only the payor owns into an account that only the payee owns. If they put it into a joint account and then the person receiving the support income transfers it out, we cannot use that income because you cannot pay yourself support income. So some of these receipt guidelines have to be carefully explained to the client and understood, so that when it comes time to applying for a mortgage, we look back, and even though the income has been received for a long enough period, it is not usable, it's not qualified income because it hasn't followed the right chain and it hasn't been documented properly. Also, if, for example, one spouse who's paying the support income decides, well, I have to pay my spouse, let's say, a really large amount, $5,000 a month. And from that, I know that my spouse sometimes is late with the mortgage. So I'm going from that 5,000, I'm going to go ahead and pay the mortgage, and I'm going to pay the utilities, and I'm going to pay the school tuition for the kids. And then I'll transfer the remaining $1,500 to the receiving spouse. Again, we cannot use that because we can only use the amount that was transferred. So consistency and stability is really important. And that is something that I do is when I talk to the clients, I kind of explain, this is what it needs to look like so that they're not surprised and we don't have any barriers when it comes time to applying for a mortgage. In addition, there is the 636 rule that we use within the lending industry. And what that means is that support income needs to have been received for 6 months. This is for conventional loans, for 6 months, and it has to continue for another 36 months from the time the loan closes to be able to be used for mortgage purposes, to be qualifying income. 6 plus 36 equals 42 months. So at a minimum, support income has to be awarded for 42 months. With child support, we don't have any say in that. It's based on the child's 18th birthday. But for alimony, spousal support, that is something that can be changed. Is that correct, Susan?
Yeah, and it's, I guess you could have a smaller amount for a longer period of time, and that would allow you to meet that. Is that correct?
Exactly. If you think of it as a pie, basically, as a full amount, And instead of having, I just throwing out a number, $1,500, and it's only for 36 months, maybe we go to $1,200, but it's for 42 months or longer, then it allows that receiving client to actually use that income to qualify for a mortgage, and it makes a huge difference. So the 636 rule is something that we need to remember. We always need a minimum of 42 months, except for when it comes to purchases. If the client is looking to get into a new home, we really want to account for the time that it takes that client to identify a property, make an offer, have the offer be accepted, get an inspection, go through that negotiation process, and then get on the contract. And then from the time of contract, we need the additional 36 months. So generally, if you think of it, the purchase, the research and negotiation purchase process may take 3 to 6 months. We need to have that cushion built in. So for purchases, I recommend a minimum of 48 months so that the client has enough time to find a property and make sure that they get on the contract and they have enough income continuing to qualify for that mortgage that they want to purchase the property.
That makes a lot of sense. Interesting.
Yeah.
Okay.
Another thing to know about support income is that for alimony and for child support as well, it can be grossed up by 25% for the receiving spouse if the award was made after January 1st, 2019. So if, for example, we have a spouse looking to purchase and their alimony support income is $1,000 per month, for mortgage purposes, we actually use $1,250 because we gross it up by 25%. That is really helpful in a lot of times. On the other side of that is if the award was made after January 1st, 2019, the paying spouse, they get a benefit when trying to qualify for a mortgage as well. Because when we're evaluating their debt to income ratio, we list the alimony as a deduction from the income instead of as a liability. And that affects their debt to income ratio in a very favorable way, and generally helps them qualify for a higher amount because it increases their debt to income.
Interesting.
And one last little tip about alimony is that for some guidelines, for some lenders, alimony is not the same as maintenance and support. And so if throughout your documents, it's referred to as maintenance and support, that's fine. I recommend that there's a sentence somewhere in the document saying that for purposes of lending, alimony, support, and maintenance mean the same thing. And then we can tie it all together.
Got it. Got it. So if certain documents require to know, need to know what alimony is or whatever, then it's very, very clear that that's what you're always talking about.
Exactly. Yeah.
Got it. Interesting.
Yeah. Any questions about income?
I don't think so. Very, very interesting and very, very helpful, I would expect, from my clients and many people who are thinking about going through a dissolution and how to structure it.
Exactly. Oh, sorry, I went too far. Okay, great. Well, I would love to jump into equity buyouts. So I'm sure that this topic comes up during divorces quite a bit. An equity buyout is when one spouse is retaining the marital home and acquiring the ownership interest of the other spouse by paying them their share of the equity. So basically, you have a marital home, one spouse is keeping the home and paying out the other spouse who is the departing spouse. So how do you do that? Some people think that it is a purchase loan. It is not. It's actually a refinance. What's really important for us to understand today is that this type of equity buyout can be done through two different types of loans. It can be done as a cash out refinance, which is what traditional lenders do. They go and they pull out cash from the property to pay out the departing spouse. So that is a cash out refinance. But there's also another option, which is the rate and term refinance. And Susan, I don't know if you're familiar with the difference between the two, but during the pandemic, there was a refinance boom because interest rates had really dipped down to historic levels. And so most people were doing a rate and term refinance, meaning that they were changing the rate from, let's say they had a 4 or 5% and they're going down to a 3%. And then they're also refinancing the term. So if they had previously a 30-year mortgage, they had paid down 5 years of that mortgage loan, and now they only had 25 years left. When they refinanced, they went back to a 30-year mortgage, and thus their monthly payment was lower. But they did not take out any cash as part of the transaction. It was just a rate and term refinance. With the cash out, you change the interest rate, you can change the term, but you also get cash out from the equity of the home. That's the difference between the two. Is that have I explained that pretty clearly? Okay.
Yes.
So when we're structuring an equity buyout, we can do it either as a cash out refinance or as a rate and term refinance. And there is a pretty big difference between the two. The traditional cash out refinance is limited to 80% of the home's equity. So for example, if we had a home that is worth $500,000, we can only at most take out $400,000. So depending what the existing mortgage in place was for, let's say it's $350,000, we can only get an additional $50,000 because then we're reaching up that ceiling, that 80% ceiling of the loan to value ratio. In addition, cash out refinances will carry higher interest rates and higher fees than a rate and term refinance. So by contrast, a rate and term refinance can go up to 95% of the equity in the home, the loan to value ratio, and is generally between 0.5% and 1% lower interest. And of course, the monthly payment is going to vary a lot between what the loan amount is and how many years. But for just an average loan, I think I was looking up something around $500,000 loan for a 30-year fixed rate. A 0.5% to 1% can be somewhere between $300 and $500 a month increase in the monthly payment if we are going with the cash out instead of a rate and term refinance. So these options a rate and term refinance will not only help a client access more of that equity, but it can also mean a lower monthly payment for them, which will help them with their monthly budget.
This is all together from what you were talking about at the beginning about figuring out their budget and then figuring out what fits with that.
Exactly. The monthly budget is really huge because you don't want to be eating ramen. Yes, you want to keep the house, but you want to be eating ramen the rest of the time. You want to make sure that you account for your living expenses. And just because you qualify for a certain amount for a home, I don't always say that you should go for that max qualifying amount. You really have to consider all your expenses and also your lifestyle, what you're used to. How often do you eat out? What are your hobbies, and how much do you need per month to make sure that you live comfortably? Mm-hmm. So that is part of the analysis that's really important. All right, so this is an example of the equity buyout. So let's say we have a property that's valued at about $500,000 and the current mortgage is $350,000. And so a half share, it will be $75,000. So we have $150,000 total equity left in the home, correct? And half of that would be $75,000
under the community property law. So yes,
and if it's structured as 50%, exactly, right. And it can be different depending on their scenarios. But this is just a typical example to show the math and show you what the difference is between these refinances. If this equity buyout was structured as a cash out refinance, then the most this couple could pull out of their home before hitting that 80% loan to value cap is $50,000. And remember, they need 75. So unless they had other assets available to make an equitable payment, then the spouse wanting to keep the home might have to actually sell and wouldn't able to keep the home if they needed to pay out $75,000. If this equity buyout could be structured as a rate and term refinance, then they could access up to $125,000, which would be enough for the 75. So this is one example where this can come into play. We see this quite often.
That makes a lot of sense, and I can see where it would be, depending on, what your payments might be, and how much you might need after the equity buyout. Yeah.
Exactly. Now, there are some restrictions to be able to structure an equity buyout as a ready-term refinance, and I'll go through these really quick. First, the equity buyout must be addressed independently or just by itself in a paragraph from all the other marital asset divisions. So it needs to have its own paragraph. No cashback at all is allowed to the borrowing spouse. So we can only include the equity buyout amount that's going to the departing spouse and the loan fees and costs. So prepaid, such as the taxes, the insurance, recording fee, escrow, all of that, but nothing else. We cannot add in a HELOC. We cannot add attorney fees, credit cards. If we do, then it triggers a cash out refinance, and it goes back to that first program limited at 80%. The other requirement is that the borrowing spouse must have been entitled for the property for the prior 12 months. And that's been a limiting factor in some cases. That's what part of the investigation that I do in my report is I look to see when they got on title and if they actually are eligible for this program. Also, the verbiage in the equity buyout must be very concise and specific as to who is retaining the marital home and how the payment of the equity is going to be made. If possible, I recommend that the equity is set as a percentage instead of as a dollar amount. And here's why. As you probably have seen, the values of properties have been going up and down quite a bit. And so if we do an appraisal now in April, and we figure out the house is worth, I don't know, 500,000, but then this refinance doesn't actually happen till July at the peak of the housing market, well, that home might be worth more. And so the equity by then can be substantially higher. And if you are in a position where you're dividing the equity 50-50, then you want to list that as a percentage instead of a specific dollar amount. If, on the other hand, the assets have all been divided in very specific ways, and it has to be a dollar amount, that's fine. But whenever possible, from the lending side, we do see that can be a problem. So we do recommend to consider setting it as a percentage if it fits within your scenario.
That makes total sense. Yeah. Because the housing market these days,
it's up and down all the time.
Yeah. Mm-hmm.
Wanting a realistic time frame, again, taking into account the 636 rule, if there is going to be support income that we need to use, or some type of an alimony trust, or maybe the borrowing spouse is re-entering the housing market, the workforce, we have to plan for that. So the timing is something that needs to be included. And also the taxes and any type of debt. So if any property taxes were due on the property and the property is in arrears, as far as that is concerned, we have to take that into account and figure out how long will it take to get them to be current to make sure the transfer can take place. While I'm talking about escrow accounts, this is something that we see very often is when there is a refinance. If the client had an escrow account, if they were prepaying their taxes and insurance along with their mortgage payment every month, those funds went to an escrow account. When it comes to refinancing, that escrow account gets closed out and the full balance of the escrow account gets refunded to the person or persons listed on the mortgage. So if you have a couple and they're both on that account or on the mortgage, the check gets issued in both of their names. So you have to kind of plan for that. And sometimes this escrow account can be substantial depending on the type of the year. It can be $4,000, $5,000, $10,000, depending if they have a multi-million-dollar property and they have a lot of taxes that were prepaid. Account for that because it is going to be a big payment coming through, and they want to make sure that they coordinate because they both have to sign up on that check.
Right.
And if they no longer have a joint account, they still have to be in agreement of how that check is going to be deposited. Okay. going back here, I do have a couple of other tips that I want to discuss with you when it comes to equity buyouts. One of it is, how do you determine what the property is worth? And there are really a few ways to do that. Some couples, if they're in agreement, they can look on real estate platforms like Redfin and Zillow and see what the amount is and do kind of an average. I can tell you that as a mortgage professional, those platforms are very unreliable. Right now, over the past month or so, I've seen the values really trailing what's happening in the market, and they're not very accurate. So be aware that it may not be a very accurate representation of the value of the property, but it is an option and it's very cost efficient because you don't need to spend any money in doing that. If you are going to not want to spend any money in getting the property appraised, I do recommend that you get a comparative market analysis or CMA from a real estate agent. A lot of times, a real estate agent can have more insight into the specific property and what other properties around this that have the same features in the same neighborhood have sold for in the past 30 days. And CMAs tend to be a lot more accurate than looking at real estate platforms such as Zillow or Redfin. However, if you really wanted to make sure that you know what the value is, I do recommend an appraisal. When it comes to appraisals, there are two types of appraisals. There's one that is known as the lender appraisal, which is done on a Form 1004, and it's the Universal General Appraisal Form, I believe it's called. And that is done whenever there is a refinance or new purchase, then the lender is going to generally require an appraisal be done. There's also another appraisal, which is the general purpose appraisal form. And it has the same information, but it's put in a different type of report. And unfortunately, if that client who is getting this property appraised is going to start a refinance and they get the appraisal done, but then later something happens and they decide that no, they need to actually go through litigation, courts are generally not going to accept or may not accept the lender required appraisal because at the bottom there's specific language that says the intended purpose of this appraisal is only for lender required appraisal. And then on the flip side, lenders are not going to accept a general use appraisal. So you may want to coordinate and figure out the timing, and also keep in mind that the market is really cyclical and that property values may increase during summer months and decrease during winter months, and make a plan so that clients don't have to pay for an appraisal twice. But important thing to know is that you can look at real estate platforms, you can get CMAs, or you can get an appraisal. And when it comes to appraisals, there's two types of appraisals, one used by lenders and then a general one that's usually used for litigation, and they're very different.
Got it. Yeah. I know CMAs are something that we're doing, in a lot of my cases. But if you're talking about doing this sort of refinancing, I guess you really need to consider doing something more than that because it's going to be necessary.
It might be, yes. Or if you said it, depending if all the other assets are divided and all that's left is the home, then you may agree to do it as a percentage. So whether or not that property value goes up or down, and all you have left to divide is the home, the equity in the home, and it's set as a percentage, it really doesn't matter what the market's going to do because you will have that lender required appraisal, and based on what the value is divided by 50% or whatever percentage you decide that it needs to be divided by. And then you don't have to worry about the increase or decrease in value.
That makes a lot of sense. Yeah. So I know I had some questions that let me find not finding my mouse here. There it is. So we talked about support income. Are there any other pitfalls or loopholes that you think that need to be addressed, in thinking about these sorts of things?
I have another small tip that I want to talk about when it comes to It's not specific about income, but it comes into play with equity buyouts. And it's about inspections. So if one spouse is keeping the marital home, it may be prudent for them to pay for an inspection. A home inspection will reveal possible big ticket items, imminent repairs that may be coming up, like a roof that could be really costly, or maybe something that has to do with plumbing or electricity or a new fence. And so when you're looking at, okay, dividing the property, what is the value, the spouse keeping the home, all of a sudden they know that in the next 12 months they're going to need a new roof, or that has to be budgeted for and that has to be included and discussed. I never leave my lane. I never cross over into giving any kind of legal advice, but I want to identify that there's some issues that have to be discussed. So I always say, okay, if you've done a home inspection and you know that you're going to need a new roof, or your electricity or plumbing needs to be replaced, and that's going to cost, I don't know, $30,000, that is something that you have to discuss with your attorney and make a plan for, however that's going to look. As far as other loopholes, really it's this alimony, making sure that it's going to be awarded for a long enough period of time. And also the trust income, when there is no income, if one side is getting a big lump sum, there are ways to turn that into income, and they can qualify right away. Sometimes they don't even have to wait 6 months, but that requires advanced planning, or else the options really, it becomes unavailable as soon as the divorce is finalized.
Okay. So can a spouse with no income or employment qualify for a mortgage?
That is exactly what I was just mentioning, is that if there is a lump sum, or if they have assets, there are ways to make it work where even if they haven't been in the workforce or they're just returning to the workforce, we can supplement their income from their job, or just use their assets, or just use the lump sum, or any combination of that. And again, that is going to require some advanced planning.
So advanced planning is when you're talking about that, you're talking about both what you do, but also in the process with your family law attorney, making sure that what needs to be said, for example, in the dissolution documents is phrased correctly, that things are set up correctly in the actual dissolution documents, correct?
Yes, absolutely. Yes.
Okay, so it's really good. For example, if they hired me as a family law attorney and then hired you, or kind of we work together to try and make sure that everything is in the dissolution documents that sets them up for success in whatever areas they're trying to do.
Absolutely, yes. And Susan, if we have another minute, I do want to talk about assumable loans and what happens when a loan cannot be refinanced. Do we have time for that?
Yeah, absolutely.
Okay, great. So this is the third part of the questions that come up all the time. Can I assume the loan, or can my spouse assume the loan and take me off the mortgage? And the short answer is yes, sometimes that is possible. It's very rare, and used to be more rare. Even 6 months ago is really unheard of. But now it seems like a lot of lenders have opened up that requirement, and they're allowing more and more loans to be assumed. Generally, only government-backed loans such as VA, FHA, and USD loans can be assumed. But like I said, more and more lenders are allowing their loans to be assumable, and sometimes that has to do with a private portfolio, or just trying to retain some of their clients. But there are a few things to keep in mind when it comes to assumable loans. First, know that it can take a really long time. It used to be a couple months ago, the process was about 4 months. I spoke with a client yesterday who called Chase to find out, yes, her loan is assumable, but it's going to take a minimum of 6 months. So of plan for that. If that is the process you want to do, make sure that you account for that time period. The other thing is you want to ask to make sure that if the assumption is done, then the departing spouse is fully removed from the financial contract. Because in some cases, all they do is they take their name off the actual document the mortgage statement, but they still have financial liability. And so that mortgage will still show up on their credit. And if the spouse that's keeping the home makes a late payment, it will affect the departing spouse's credit.
Oh, I see.
They still have to qualify for that mortgage financially. And then the other thing is that the spouse who's taking over the mortgage has to be the one that's really on top of this process. There isn't anyone on the other side who has any incentive to making sure that this assumption goes through. So they have to be the one that is really aware of the deadlines, what needs to happen by when, to make sure that it gets completed. And when they get that first loan estimate, be really careful that the new interest is actually the interest that you previously had, that the lender hasn't switched and refinanced you at the higher current interest rate that's available in the marketplace right now, because we've seen some bait and switch activity happen. So that's what's important to know. Yes, it's doable. It's going to take a long time. You have to be the one that stays on top of this process and make sure that it's really being assumed and not refinanced.
Interesting. Yeah, I don't think I've worked with assumed loans, as you say. It's been rare, but that will be something I will definitely be talking to my clients about and sending them to you so that you can figure out that timing and tell me what to put in the dissolution documents.
Absolutely. And let's see, I'm going to go over here for this is Susan's information here, and then my information below. And I'm not sure how we do on time, but I do want to discuss one more thing, Susan, if time allows.
Absolutely, go right ahead.
Okay. The other conversation that I have with clients very often is, well, if the assumption doesn't go through, I understand that I qualify for a refinance, but the interest rates are so high. Is there a way for us to basically keep the mortgage as is? And what happens? What are the options? And I always defer back to their attorney for that, because in some cases that might not be a really good idea, depending on the couple, if they continue to have a joint liability. But in cases where they do, in cases where that is an option, if the staying spouse is awarded the property 100% and they're 100% liable for the expenses of the property, the departing spouse can actually go and make a new purchase, and the current loan is not going to affect their debt to income ratio. So it is possible that they can wait to refinance 6 months or a year until interest rates decline further. They have already started to normalize. But a few things have to happen. That has to be spelled out really well in the documents. And then the other part of that is, how does the departing spouse protect their credit? What if the staying spouse makes a late payment? How do you deal with that? And I've seen some creative solutions, and I don't know, Susan, if you've seen this as well. One solution has been to perhaps have an account where there is the house is 1 to 3 months of mortgage payments, so that if, for example, the departing spouse has proof that the staying spouse has actually made the mortgage payment by agreed upon date, let's say the 10th of the month. If by the 10th of the month, the spouse who's supposed to make the mortgage payment has not made the payment, then the departing spouse can go into this account and make the mortgage payment from there. Then they can set all kinds of conditions to make sure they're protected, but I've seen some creative solutions around that. I'm curious if you've seen anything like that.
I know that there's all sorts of creative solutions that we're working with these days, especially in mediation or in the collaborative divorce context, where we're trying to figure out ways for people to do all sorts of things with their property, and having this expertise on board, especially, as you said, you work within the collaborative law process a lot, and I'm getting into that realm. And this sort of working together as professionals works much better in that process. And it's one of the reasons why I'm hoping to and trying to present to my clients the advantages of the collaborative divorce process, so that we can try and do these collaborative, creative things in litigation. And the other aspect of being a dissolution attorney, sometimes you try to be creative, but it's not, the other side isn't as receptive to it. And one of the reasons I like collaborative divorce is that you have the coach working with both parties, helping them deal with those kind of difficult issues that make it problematic for them to be able to talk with each other or work with each other cooperatively. Because, in the end, if you want to refinance the house for, to have the family and the kids be able to stay in the house with one of the spouses and try and have the best possible future for everyone, trying these creative approaches and in the collaborative law context, it's a better outcome for everybody, and people walk away with much better futures. And I think that's why you do it too. So
100%, I completely agree. And we actually met within the context of collaborative law training.
We
Yes.
did indeed. We were both doing that, and I hope to steer more of my clients into that, because I do think it has both better outcomes in terms of finances, but also in terms of all the other aspects of dissolution that can be so difficult.
Absolutely. And I can tell you, Susan, from my experience, when the spouses are able to work within this more amicable, cooperative, collaborative setting, that in turn equals better financing terms for both spouses. Because sometimes you do need, there needs to be a little bit of give and take and helping each other out. And if they are more willing to work together, a lot more can happen that can benefit both of them. And if there's kids involved, especially the kids.
Exactly. And I think that having all the professionals that are involved in the collaborative process helps them get to that place. And I'm very, very grateful to you for talking about the financial aspect of that. And you've been a wonderful guest today. Thank you so much.
Thank you so much for having me. This has been really a really great experience for me. I really appreciate it.
And I appreciate you. Take care. I will see
Thank
you
you.
next time we have coffee.
Sounds good. Bye-bye.
Bye-bye.
Bye.